Hi everyone, this is Rohit Srivastava recording for the 21st of January 2017. We've just completed 3 weeks up for the Nifty, achieving the initial target for this bounce back that we were looking for. But there is still no sign of any trend reversal, and therefore we are going to have to keep open the potential that if you get past 8460, you're going to be testing higher levels, probably the 61% mark, which is 8560, and who knows, even move beyond that. Last year, exactly a year back, I was starting to look for the potential of an X wave, and there were some key factors which uh, were present at that point of time, and they are present even today. And At that time, those factors did not immediately come into play because you had all the bad debt write-offs that were going on by the end of Jan and into Feb, and our own market continued to fall against those trends. And those trends were essentially that, by the end of December of last year, the dollar had reached its peak and was actually falling in the early part of January, and that had put downward pressure on US equities and was causing a rally in the precious metal space. And eventually the falling dollar got followed up by a bottom in the emerging markets by the mid of the month, and in commodities by the end of the month. And we are essentially, and somewhere in the third week of the month, I think commodities started to rally, and we are looking at that being a reversal for all the weakness that we'd seen in currencies all year round, and the weakness we'd seen in commodities all year round as well. So everyone was extrapolating those trends forward, and I was saying, people are reacting to old news, yesterday's news, and you need to look ahead. And essentially our market still did not respond to that because of our own reasons, but it eventually did later on. Since June of this year, we've seen a steep correction in all of these assets, which is your commodity space, starting with the precious metals, and more recently, in the last 2 months, we saw correction in copper and various other commodities that had rallied through this phase. But in the last month, in my long short report, essentially I wrote about the inversion of various asset markets, and we've seen a couple of them already happen. The setups were exactly the same like we were seeing a year back. You were seeing the dollar run away, and people are expecting that to go on. I've been writing that the dollar could actually be peaking. And I've been saying that for quite a while, all the way as it moved through 102 to 103, all the way to 104, which is essentially the 61% mark and then the 66% mark. And we finally sold off from there, pushing off some of the weekly indicators, and we're going to be seeing whether the dollar reversal gets bigger. My sense is it should, because you've ended what is an 8 to 9 year bull run in the dollar, and that's typically what you saw even in the last dollar bull market, which was from somewhere around 1992 all the way into 2001, and that was another 9 year period that you saw the dollar continue to go up despite of corrections from the bottom to the top. And so you've had another such period, and so for the same reasons, a year back, when the dollar made its first peak, you got a runaway in commodities, and then you've seen a correction. And more recently, and I've been saying it all month, with a lot of debates, specifically those debates being more around precious metals than anything else, people started believing that you can have base metals go up but not other commodities, and but a lot of that logic is not well founded, because if you simply go back and look at history, you will not find any period where the entire commodity pack with some lead lag has not moved together. I mean, have you ever seen a period where you have rising prices of copper and falling prices of gold and silver? Maybe for short periods of time, a few weeks here and there, but have you seen it happen for a couple of years, for example? So when you're talking macro trends and you're trying to say, rates will go up, this will go down, you've really not studied history of any of that data. You'll find a chart from the long wave group in my quantitative economic winter articles on the website, and those charts essentially show the trends in the key factors that we study in the economic winter, which is interest rates, inflation, gold, all of them on a single chart, including gold stocks. And you essentially see that there have been patterns to these trends over that last for several decades. And you look at previous periods where you had inflation, like you look at just the 70s, not very way back from the US markets perspective. Then you had rising interest rates which were coming in all the way from the 60s, 70s into the 80s. So 80s, when commodity prices peaked, it was actually the last phase of the rate cycle in terms of rising interest rates. It's probably the most aggressive rate stance was taken that actually caused a pause to the rising inflationary trend that had been around for that decade through the 70s into the early 80s. And then from there on, you saw not just lower inflation but lower interest rates. And again, that trend has been around now for almost 30 years on a macro scale, though there are, several ups and downs in between. So when people are looking at inflation picking up, we've just seen Eurozone data, which I tweeted some time back, bouncing back from negative levels to over 1%. US inflation has also been ticking up all the way to 1.8%. And I think by next week, you'll have their data for this month, January itself. And if it further ticks up, essentially what you'll end up watching is what we call real interest rates. And that's the difference between inflation and interest rates. So if you have an inflation rate which is well above the interest rate, then you have a negative real rate. And the negative real rate is essentially typically positive for commodities, in particular for the precious metal space. And which is why the trend you're seeing now, so essentially what I'm calling for, and after 5 years of a bear market in commodities, and I would actually say 5 years is just one leg of it, which is wave C, and typically a bear market is A, B, and C. So starting from 2008 into 2016, you had a 9-year bear market in the commodity space, which breaks up into A, B, and C. And this was the first year we actually closed positive for commodities. The CRB index of commodities closed positive for the year after 5 years. And I think that marks essentially what I was saying a year back, that you've got the bottom in place. You had a rally which lasted for 6 months. You've seen a correction into the year end. And now very clearly the commodity rally has resumed, at least when you look at things like metal prices, which is why metal stocks have been the hottest in the market once again. Following what happened last year, and during this corrective period, you only saw consolidation in metal stocks, whereas the Nifty itself did correct much more. And now you're even seeing, each and every part of that commodity market participate. So the view I was actually taking a year back was that it's not going to be only limited to metals or precious metals. It's going to be across the board, which is one of the reasons why I studied all of the commodity sectors, and one of the segments within that which I highlighted and wrote about. And I think I covered most of we've covered most of these stocks if I combine what I've written about on India charts or our own reports at Sher Khan that we put out. Essentially, the entire sugar sector, which was one of the agro commodity segments that did really well. And my sense is that agro commodity prices would pick up across the board. We've not seen a significant pickup in maybe prices of rice. We are seeing wheat prices go up, at least on NCDX. You can see they are close to all-time highs, just seeing a recent correction from there. And today I've written about soya oil. So soya oil prices have been in an uptrend for almost 6 to 8 months. We've seen a bottom in maybe coffee prices, which rallied from almost 100 to around 130, 140, and then they've corrected a bit from there. But I think another move up would start. So essentially, it is slowly spreading. The agro space is a little more slower to move than metals, and all of them which did bottom saw a rally. Some of the others have still not seen it in the international markets, but I think they eventually should. And then you'd have probably every part of it having participated. Oil itself, crude oil, for example, did rally from 25 to 50. That was also another commodity that was well debated. When it hit 30, everybody was talking about 20 and 15, and I said that at least get a move from there to over 40 or maybe closer to 50, and we did get that. And after that, even I considered for a while that you could resume the move down, but essentially what you ended up getting was a consolidation between $50 and $40. And now the next move up has essentially started, which can very well go back to 60, 61, which looks like a minimum kind of a potential target. What is not clear is whether you'll overshoot that, because if you do a broader projection of an ABC move up, you can actually stretch the move all the way to $70. So that becomes a potential meaningful upside for oil itself. So that's how each and every part of the commodity pack would end up participating on the upside, and it could actually become a bigger trend if I am right about the dollar having peaked and ended its 8-year bull market cycle. We are in the early days, like I said, 104.66% worked as a good resistance. We've seen a 3-week sell-off from there. We've still not fallen below the breakout point of 101, which was the trend line of all the highs it has made over the last 2 years, 2015 high to the 2016 high. And that trend line stretches to 101. We paused just above that, and if we actually close below that on a daily or maybe a weekly chart, then that would further confirm that that breakout was either a final move or a false move based on how you wave count it, and essentially would mark a reversal of that trend, and it would then become a significant trend going forward. So I think these are the macro trends, I think, which I've identified, written about in my last month's report, and will continue to write about in my daily and weekly updates as well. The other one, which will not be not at least longer term, but at least an immediate effect, is that the big sell-off we saw in bonds, and I thought they would probably have, the yield would have started to cool off from 2.3 itself, but it stretched all the way to 2.5, 2.6% on the 10-year US. But we've started seeing that cool off happen now. Finally, you have a rally on the daily charts, which is come close to the 40-day average and reacted from that this week. We really want to see if that rally continues into another wave in the coming week or so, and a reversal in the bond market, while would be a multi-month near-term affair. I do feel that we've seen the long-term top probably in the 30-year and 10-year. In fact, the 10-year prices did not go above the 2013 highs. They made a significant retracement. The 30-year essentially did make a new all-time high, and you ended up with what we call a massive inter-market divergence between those two, which is why it could be signature of a long-term top being put in place. But bond markets are slow-moving animals. They don't really move that fast, even on the way up. And so on the way down, well, we've seen a 4 to 5 month sell-off that well enough creates room for you to get a couple of months of counter trend on the upside, and which is what causes sometimes a reaction to the US equities. But at the same time, when you have the dollar selling off, you also have emerging market currencies strengthening, the pressure cooling off, and kind of positive fillip for a lot of the commodity based emerging markets, which were actually under pressure over a year back. So that has its positive rub-off effect, and that kind of an environment, I think, when it comes to the Indian market, we essentially end up doing our own thing, which, because we are not neither a heavily commoditized market, though that particular sector, which is cyclical, the commodity sector itself, is doing well, and I think will continue to do well across those segments within the commodity space, each of them doing well for several months, maybe the rest of the year. And but the market as a whole, the Nifty would be very, very dependent on our own cyclical factors. And we haven't really seen earnings grow for, now the 7th quarter is what we are heading into. I think since Jan of 2015, earnings growth dropped from, what was close to double digits to single, and then into almost close to negative territory for one or two quarters in between. But in general, we haven't seen significant or meaningful earnings growth, and this quarter too would probably end up being something like that, given the measures that we've taken on the demonetization side for this quarter, maybe next quarter. And so you're not really going to see that. You're going to look for other triggers, maybe something from the budget. And given that we're still waiting for numbers on what the impact of this measure would be. The initial sense is that if all the money is really rolled back and everything is status quo, then the gains from the measure in terms of any write-offs that on the currency side that could have actually become a benefit would be missing. And so the government is still going to need funds for going ahead with its plans. And I think when I look at it, there are essentially two major steps that I'm looking at for marking the end of the winter. And of course, the economic winter, as we look at it and is studied, is essentially studied more rather than a fixed value of the index, but a relative value in terms of either inflation or gold. And so we've really not beaten inflation for many years. And the key issue coming back to that is that you need to recapitalize your banking sector. I think that's well known and publicized. I was writing about India's debt problems way back in 2009-10. Every stock or company that was high on debt has not performed for the last 6 to 8 years. Other sectors, defensive ones, and those that were benefited from the currency devaluations, definitely did well in the interim. But that trend essentially became the macro trend. It was not accepted or acknowledged by anyone till I think a year back, when our own NPAs were actually brought out into the open. And it's very clear now that we need to first recapitalize our banking system and get it ready to start lending again. And then secondly, followed by that, once we've corrected some of our internal issues that in future would not cause an inflationary rub-off when it comes to spending. It should be possible for the government to actually spend money and what we call deficit financing, or using the fiscal side to essentially stimulate the economy, to use the right word. And without that, I don't think we move ahead. So these are the two steps that have to occur. The first has to be recapitalization. And if there are any negative effects of that in terms of needing the funds, cutting back on expenses, that slowing down of the economy essentially should have a positive rub-off in terms of future spending not having an inflationary impact, which is the main reason why the government is not able to step up its spending plans. Essentially, every time it does that, like it did in 2008-9, you end up with major inflationary effects, which we have not been able to handle, and has actually led to the toppling of governments. And so no one in power wants to be in that situation and be blamed for inflation. And therefore, you need to solve that part of the problem through some form of reform. GST was one of the major measures which is still to be fully implemented, and its effects to be felt on the real side. And so in that interim, we have time to really recap our banks. And until we've not done these two things, I don't think it will be possible for us to be out of the winter cycle situation. And therefore, the index itself might not do so much as particular stocks and sectors, which has essentially been the market since 2010 onwards. It has been a sector specific, theme specific market. It was down into 2013. Still a couple of defensive sectors were holding out. Even after the Modi rally, when you look back, you find many mid and small caps actually sold off again after the initial enthusiasm. With almost 70% of these stocks that had gone back above their 200-day averages going back below them. And what has really held out was only sectoral or theme specific stocks. And even within that, we've seen significant weakness now coming into the pharma sector, which was one of the best performing sectors last year. We've seen it in IT, we're seeing it in FMCG. So where do you really go? And I think I've probably nailed it in terms of the commodity space for this year, and the agro space for last year, which both of which trends I think will continue. And of course, OMCs, which also were related to the crude price, which was again a commodity based trade. So I think I covered all of those. And there was only one or two, I think, pharma stocks which I covered, which are not really affected by what is going on in the US. But the point is that when do we end this thematic phase? We only end it when those two macro measures are actually taken place, and then you can get a real bull market as far as the Nifty is concerned. For the time being, you continue to look at a retesting of higher levels within the broad range, which is at the lower end. This time it held 7,900. I don't think most people are expecting it to go to 75 or 74, but I think once it turned, we slowly managed to turn and ride it on the way up. But we did think that we could have seen at that point lower levels. At the same time, the upward range has been capped. We've seen two highs occur close to the 9,000 level 9100, then 8960, and if you draw a trend line of those highs, you'll probably come to 8920, and that forms the upper end. I'm not sure you'll see new highs in this market. It will remain a stock specific and a thematic market till we've really completed the winter cycle. But at the same time, around the world, emerging markets are making a comeback on the back of what looks like a falling dollar, and is being read into, at least for the time being, as a repeat into what happened post 2002 when the dollar actually peaked. Though when I did study the cycles of the dollar, when you look at each period of a bull market or bear market in the dollar for 6 to 8 years, each phase has actually been very different from the previous one. So it's never a copy paste picture perfect repeat of the past. There are different reactions to it, essentially because the economy is in a different state at each point of time. In 2002 versus today, you wouldn't be at the levels in terms of debt where you are today than you were back then, and therefore the effects could be very different when you start anticipating that you'll have higher inflation rates, and you'd have to actually follow it up with a higher interest rate cycle. And as long as the rate cycle is behind the inflation cycle, you might even end up considering what did happen after all the QE, which is a hyperinflationary event or a inflation shock. So those are all potential possibilities. We'll be tracking them, but right now these are trends which are just looking normal in terms of the falling dollar, rising commodities, a potential rising bond bounce back in the bond market, maybe some kind of a risk off trade from the US markets, and a reversal in emerging markets as well at the same time. So that's all in this update for this week. Thank you.